So, investment fluctuation reserve. Already I have discussed the cases related to treatment of investment fluctuation reserve, but in brief, right? Now let's have discussion about this in detail. All the cases we are going to understand in detail theoretically, and I'll tell you the journal entries as well, and thereafter we'll do the numerical question as well, right? So have a look here. There are three cases. One, when market value is equal to book value. I have already explained you the concept of market value and book value. One more time I would like to remind you that book value of the investment is the value which is given in the asset side of the balance sheet, right? And market value of the investment is the current value in the market which is going on. If you are ready to sell your investment right now, so at what value it will be sold out in the market, that value is known as the market value, right? It keeps on changing. Sometimes it goes high, sometimes it goes down, right? It keeps on fluctuating. Just because of that, this reserve is maintained, investment fluctuation reserve, so that this fluctuation can be compensated. Understood the point? Okay. So one case, market value is equal to book value of the investment. Second case, when market value is less than the book value, right? Only for this particular purpose, this investment fluctuation reserve is maintained, right? Okay. And when market value is more than the book value, then every organization wants the same. When an organization invests money in the market, they want it to be more and more, right? Okay, so that is the favorable situation. Okay, and here no profit, no loss. Okay, here there are three cases. Okay, if the market value is less than the book value, say for example book value is the 1 lakh and the market value is 80,000, right? Now we need to see that 20,000 difference is there. Now against this 20,000, how much amount of investment fluctuation reserve we have maintained? If we have maintained the investment fluctuation reserve of the same amount, which is a very rare possibility, then this comes under this category when fall is equal to amount of IFR. Understood? Another case, the high possibility when fall is lower than the amount of IFR. That is possible. I give you the example that 1 lakh is the book value and 80,000 is the market value, and we have maintained reserve of 20,000. Say for example, we have maintained reserve of 30,000. Okay, so in that case, reserve is 30,000 and the fall is 20,000. Means it is lower than the amount of IFR. So this is the case. And the last case, when fall is higher than the amount of IFR, it is also possible. Okay, with the same example, I just make you understand. 80,000 is the market value, 1 lakh is the book value, and reserve we have maintained only for 10,000. Okay, but the fall is there of 20,000, so that is more. Understood? So these three possible cases are there. Now let's understand what journal entries will be passed in all these cases one by one, right? So very first, let's pass entry in this case, the case 1, when market value is equal to book value, right? So in that case, this investment fluctuation reserve is not required. Why? Because this has been made just to compensate the fall, if there is a fall in the value of the investment. But there is no fall. 1 lakh is the cost of the investment, and if you want to sell it right now in the market, then in market also you are getting 1 lakh, right? So this reserve will not be utilized in that case. So in that case, this entire reserve will be distributed among or between the partners. I would like to remind you, we are discussing it in context to change in profit sharing ratio. So whenever partners are deciding to change their profit sharing ratio, they are supposed to distribute the reserves and profits, right? If any specific purpose is there, so that purpose has to be sorted out first, only then the distribution is done. But right now there is no purpose because fall is not there. So entire investment fluctuation reserve will be divided or distributed between or among the partners. And what will be the entry? I would like to show you here, right? Have a look. Investment fluctuation reserve account debit to partners capital oblique current account, being IFR distributed among the partners in old ratio. Understood? Now let's talk about these cases. So let's understand when market value is less than the book value. Okay. So very first case is that when fall is equal to amount of IFR. Okay. It means the entire value of IFR will be utilized to compensate the fall. When entire value has been utilized, then there is nothing left for partners to distribute, right? So here at this point, partners are not going to get anything, but one entry will be passed for compensating the fall in the value of investment from the IFR amount, right? How? I just show you. Okay. So the entry is investment fluctuation reserve account debit to investment account being IFR utilized for the fall in the value of investment, because that was the only purpose. Now let's talk about this second case. When fall is lower than amount of IFR. Now here, very first the fall will be compensated out of IFR, then remaining amount will be distributed between or among the partners. How? I will show you. So we have a choice. We can either pass two entries, one for this similar purpose and another for this. Okay. Or we can do one thing. We can do one combined entry. So I think that will be the better idea to make combined entry. Okay. One entry will be for this and one will be for this. So you can see that in both cases investment fluctuation reserve account is debited. So we'll directly debit it here. I take this case B here. So now you can have a look here. Investment fluctuation reserve account debit. Okay, to investment account, to partners capital oblique current account. Okay, being IFR utilized for the fall in the value of investment and surplus distributed among the partners in old ratio, right? So this is there. Very first we will compensate the amount out of IFR, then the remaining amount in the IFR will be distributed between or among the partners. Understood? Now let's discuss this case 3. Okay, when fall is higher than amount of IFR. So I need to mention it here as well. Okay. Now we have maintained the reserve and the fall has exceeded that, right? This is a situation of loss, and loss is supposed to be shared by the partner. So two entries will be passed here and it cannot be combined at all, right? What entries will be there? So one entry will be passed here, investment fluctuation reserve account debit, revaluation account debit to partners capital or current account, being IFR utilized and loss transferred to revaluation account. Why? Because this loss will be temporarily put into the account, that is revaluation account, and later on this loss will be distributed between or among the partners. The entry will be there, right? You can have a look. Partners capital or current account debit to revaluation account, being loss on revaluation distributed between among the partners in old ratio, right? So now we have covered case 1, case 2, all three possibilities in case 2. Now the case 3, when market value is more than book value. This is the situation of profit. So here as well we'll pass multiple entries. 3 entries will be passed here. Let's see. Very first entry will be there to distribute the entire reserve, because when there is no fall, and this was made just to compensate the value of fall. When there is no fall, it means the entire value of reserve will be distributed between or among the partner. The same entry will be passed here. I just mentioned in short. Okay, so this is the same entry which we passed here, because here also it is not being utilized and the same situation is applied here. But here the profit will be recorded. How? I will show you. Investment account debit to revaluation account. Now we can compare here. Here revaluation was debited. Why? Because it was a loss. And now here it has been credited. Why? Because it is a profit. Investment is an asset. More value asset was created. That's why it is debited. Investment account debited to revaluation account, being profit on investment transferred to revaluation account. Okay, the last entry. Now this profit will be distributed between or among the partners. Revaluation account debit to partners capital or current account, being profit on revaluation account distributed in old ratio. Understood? So these all are the cases. Maybe possible here in that way you are not understanding these, but when we do the numerical question on this, you will understand it pretty well. Understood? Okay, once again have a look. Now let's do one numerical question related to the all cases of investment fluctuation reserve, right? Okay, so you can see the question on your screen. I have written the question here. Let's read it out. Anita, Vinita and Sunita sharing profits and losses in the ratio of 4:3:2 decided to share future profits in the ratio 2:3:4. That is useless for us, okay, because we need to talk about the old ratio right now, right? Okay, and an extract of the balance sheet as at 31st March 2019 is, in liability side we see that investment fluctuation reserve is given 36,000, and in asset side we see that investment at cost is given 4 lakh. That is what the book value. I just write it down here. Okay, and that is investment fluctuation reserve. In short, we call it IFR. Okay, show the accounting treatment under the following cases. Case 1, if there is no information. Fine. There is no information. If in any question some other information is given, but there is no information is given related to the market value of the investment, right? So in that case, we assume that the market value and the book value of the investment are equal. These are same. So the very first case will be applied here. The entire amount of IFR will be distributed among the partners. How? I just show you. So on this date we will be passing entry because they are changing their ratio from 1st April. So all the entries will be passed on to 31st March 2019. Right? Okay. So I just write down here case 1. Under case 1, what will the entry? I have already told you. Okay. So let's have a look. Investment fluctuation reserve account debit 36,000 to Anita's capital, to Vinita's capital, to Sunita's capital. We consider it here fluctuating capital, right? Okay. Now this 36,000 will be divided among these in old profit sharing ratio. So what is the old profit sharing ratio? 4:3:2. Means if we see for Anita, it will be 4/9 and the amount comes out 16,000. Similarly for Vinita, 12,000. For Sunita, 8,000. Right? Okay, so Anita is going to get 16,000, Vinita is going to get 12,000, and Sunita is going to get 8,000. That will be the entry. Understood? That is the very first case. Okay, when market value is equal to the book value. Because there is no information given, we'll assume that only. Understood? Now let's move on to case 2. Case 2 says that if the market value of investment is rupees 4 lakh, this is also 4 lakh, so means case 1 and case 2 both are same. Okay, only there is a difference of language, but the cases are same. When the cases are same, the treatment will be same. Okay, so I would write down here for case 1 and case 2, the same entry will be passed. Understood? Now let's move on to case 3. Case 3 says that if the market value of investment is rupees 3,82,000. Now let's see, 3,82,000 is the less than 4 lakh. How much? By 18,000, right? So there is a fall in the value of investment of 18,000, and for compensating that, how much amount we have? 36,000. Okay, so this case is belonging to the second category I explained to you, and in that there were 3 possibilities. Okay, so it is belonging to the second possibility. Second possibility was there when the fall in the value is less than the amount of IFR. So 18,000 is less than the 36,000. Okay, so very first we will compensate these 18,000 out of this, and then rest of the money will be distributed among the partners. Alright, so one compound entry can be passed. I just show you how. So you can have a look. This is the case 3. Investment fluctuation reserve account debit 36,000. Why? As we have already calculated that there is a fall of 18,000. When we compare this 3,82,000 with 4 lakh, there is the fall in the value of 18,000, right? So 18,000 will be compensated very first. So it will go to investment account, and rest of the 18,000 will be distributed among the partners, right? Okay, how the distribution will be done, I'll just show you. You can write it down here. Okay, very first let's calculate for Anita. Her ratio is 4/9, so that is 8,000. She is going to get. Now let's calculate it for Vinita. That is 3/9. That is 6,000. Alright. Now let's calculate for Sunita. That is 2/9. That is 4,000. Right. So you can have a look. Anita will get 8,000 and Vinita will get 6,000 and Sunita will get 4,000. So this will be the entry. We can see the narration. Being fall in the value of investment compensated from IFR and surplus distributed among the partners in old profit sharing ratio. This is the way. Understood? Now let's move on to the case 4. What does the case 4 say? Case 4 says that if this market value of investment is rupees 4,36,000, means if we compare this market value with this book value, then we get 36,000 in plus. So this is not the case of fall in the value, right? This is the case of profit on investment, the last category I discussed. So in that case, the entire amount of IFR will be distributed among the partners. Why? Because this was not utilized, right? Because there is no fall in the value of the investment, there is the increasement, right? Okay, then we will record this profit and then this profit will be distributed among the partners. So we will be passing the 3 entries. How? I just show you. So these 3 entries will be there in this case. First entry for distributing the entire amount of IFR, second entry for recording the profit on investment, and third entry distributing this profit among the partners. Understood? Now let's put the amount. The IFR amount is 36,000. That will be divided among the partners. Already we have done. Okay. Otherwise we can once again do that. No problem. See. Alright. So this was the entry in the first and second case. The same has been repeated here. Okay. Now let's understand that how much was the profit. Already we have seen that 36,000 is the amount of profit. So we'll put the amount here. Okay. Now this 36,000 will be divided among these. How? I'll just show you in the same way. So this is just a coincidence that the value of IFR and the profit is the same figure, but it doesn't make much difference. Okay, we can read the narrations here. Being IFR distributed among the partners in old ratio, being profit on investment transferred to revaluation account. Here, being profit and revaluation account is distributed among the partners in old ratio. Understood? So this is the way to do the treatment under 4th case. Now let's read the case 5. What does it say? If the market value of investment is rupees 3,46,000. So this is what? There is the case of fall, but we need to see that how much amount of fall is there. Very first we compare it with 4 lakh, then we come to know. So the fall in the value of the investment is of 54,000, right? And how much amount do we have to compensate? Only 36,000. Okay, this is the third possibility of the second category case that I have already discussed with you, when the fall in the value of investment is more than the amount of IFR. Now, up to this, it will be compensated, and rest definitely it will be recorded as loss, and loss will be distributed among the partners. How? I'll show you. So this is the case 5. We will be doing 2 entries here. First we will debit investment fluctuation reserve account 36,000. That is the entire amount we have. Okay. Then the valuation account, as we know that the fall is of 54,000. Okay. So we have to deduct 36,000 out of 54,000. We get 18,000. So 18,000 will be put here. That is the loss. Okay. And to investment account. So here we will have to put the amount of fall in the value of investment, right? Okay. Being fall in the value of investment compensated from IFR and loss transferred to revaluation account. Understood? Okay. Now this is the loss 18,000. So we will be putting this 18,000 here, and this will be distributed among these. How? Ratio is 4/9. 8,000, 6,000, 4,000. Alright, this is the way to distribute. Being loss on revaluation distributed among the partners in old profit sharing ratio. So this was the 5th case. So these are the all cases. Now you must have understood how all these cases can be treated, what entries will be passed. I have taken only one question in which all cases were there, but may be possible when you attempt the full-fledged question, then you find one or two cases or a single case, or the question having the multiple cases can also be there. So we need to be cautious about it. Okay, so attempt the question related to that. Now let's move on to another concept related to the same topic we are discussing right now, accounting treatment of reserves and accumulated profits or losses. So there is one more concept is left here. We are just having discussion on that right now. Fine. So what we are going to learn, when reserves and accumulated profits or losses are to be retained in the books. Sometimes what happens, the partners who have decided to change their profit sharing ratio from a particular date, they also decide that they would like to maintain their reserves, profits or losses at the same values in the new balance sheet as well, right? They do not want to do the distribution of these reserves, profits or losses, right? They just want to retain them at the previous values. But there is a problem then, because earlier the ratio was different, now the ratio is different. Okay, so for the fair treatment, what it is done, because we know very well that when the ratio changes, then may be possible one partner gains and another sacrifices, right? So they just pass one adjustment entry so that the gaining and sacrificing partners get adjustment, right? How this is done, I just show you. There are few steps followed for that, right? So very first we need to understand and recognize the situation in the question. In the question, it must be mentioned that the partners are willing to keep the values of reserve and profit or losses as it is, or they would say like without changing the values of reserves and profits, they would like to continue their partnership. Some kind of information must be given there in the question. So very first we have to understand, recognize that information, only then we are going to do this treatment, right? So in this treatment, what will be the very first step? Let's see here. Very first step is calculate the net effect. How it is going to be calculated? All the profits and reserves are put one side and all the losses are deducted from the profits. The result is known as the net effect, and it can be in positive as well as in negative, right? Okay, so if we have reserve, we will add profit if we have, and we will deduct losses, and whatever we get, that will be known as net effect. So net effect can be there in positive as well as in negative, right? When these figures are more than this figure, then definitely the result will be positive, or vice versa. Understood? The second step will be there to calculate the sacrificing and gaining ratio. Already I have taught you how to calculate it in video part 2, right? The step 3 is what? To calculate the sacrifice or gain share in net effect. So how it is going to be calculated? See here. For sacrificing partner, net effect multiply sacrifice share. Understood? Similarly, for gaining partner, net effect multiply gain share. Alright, so after calculating this, we'll pass one adjustment entry. Okay, so adjustment entry will be done according to this, plus or minus. If we have positive net effect, then we are going to pass the entry. Okay, we'll pass the entry gaining partners capital account debit to sacrificing partners capital account. But in case of negative effect, we will pass just opposite entry, right? So in case of positive effect, we'll pass the entry this. In case of negative effect, we'll pass the entry just opposite to that. Sacrificing partners capital account debit to gaining partners capital account. Okay, being the adjustment entry passed, right? We can put the narration here. Okay. So let's do one numerical question on this so that you can understand pretty well. You can see the question on your screen. So I have written the question here. Let's read it out. Danish, Imran and Faizan are sharing profits and losses in the ratio of 5:3:2. They decide to share profits and losses in the ratio 2:3:5. This is old and this is new, right? With effect from 1st April 2019, they also decide to record the effect of the following without affecting book values. See, without affecting their book values by passing an adjustment entry. So this is the clue. Okay, so what are the values? General reserve, this is of positive. Contingency reserve, that is of positive. Profit and loss account, credit, means positive. Advertisement suspense account, debit, means negative, that is the accumulated loss. Alright, so very first we'll do some treatment in the working note. We'll follow the same steps as I told you a moment back. We'll calculate the net effect. Okay, so this is the way to calculate net effect. We put general reserve, we added contingency reserve, we added profits and losses. Okay, then we get 5 lakh, because all these are the figures of related to reserves and profit, and this is only the loss. So loss needs to be deducted. We deducted 2 lakh out of 5 lakh, that is 3 lakh. In positive we get the net effect. Okay, now we need to calculate the sacrificing and gaining ratio. So what is their old ratio? 5 by 10, 3 by 10 and 2 by 10. And the new ratio 2 by 10, 3 by 10 and 5 by 10. So we can clearly see here there is no change, nil, fine. Neither he gained nor he lost. Okay, but here gain and loss has taken place. Let's calculate it. For Danish first, as the bases are equal, then we can directly deduct it. It is 3 by 10. 3 by 10 of positive means that is the sacrificing share. Okay, now similarly for Faizan we can do, then we get 3 by 10 in negative. It means he gained. Okay, so Faizan is gaining 3 by 10 share and Danish is sacrificing 3 by 10. Understood? Now we will go to the third step, calculation of sacrifice and gain share. So who is gaining here? Faizan, right? Faizan gained. Net effect, what is the amount of net effect? 3 lakh, we calculated. Okay, and he is gaining by 3 by 10. So what the amount comes out here? 90,000. Similarly, Danish sacrificed same amount, right? So Danish sacrificed by 90,000 and Faizan gained by 90,000. In net effect, their share has been calculated. Now we go to the last step, passing the general entry, and in question also the same has been asked. So this we calculated, this we did just for getting these amounts and just to have information about it. Now we need to pass the entry. So as our net effect was positive, right? Okay, so the positive case entry will be done, gaining partners capital account debit to sacrificing partners capital account. And who is gaining here? Faizan. Okay, so you can have a look. Faizan's capital account debit 90,000 to Danish capital account 90,000, being adjustment of reserves, profit and losses done. Right. So this is done only in the case when question mentions that the partners, without changing the book value of reserves, profit and losses, okay, they want to pass one adjustment entry. Understood? So this is all about this entire topic, which is called accounting treatment of reserves, accumulated profits or losses. We have ended it here. Very soon I am going to meet you in the another video with the further concept in this chapter. Right? Till then, bye bye. Thank you.